Hi everyone, I am Michael DeStasio, the founder of Valor Advisors. Today I will be reviewing two common tax mistakes I see police officers, firefighters, and paramedics make when managing their investment properties. The mistake costing people the most amount of money I'll review last, which you don't want to miss. Now, your investment property could be a condo, maybe even a 4-unit building. And the first is missing qualifying expenses that can be deducted against the rental income. People simply don't know what expenses qualify to be deducted. So here are a few examples. You might purchase some cleaning supplies. Maybe you even pay a neighbor to clean up the hallways. If you're a skilled electrician and upgrade the wiring yourself, that could potentially count too. There are even other expenses for managing the property and even the mileage to pick up the rent or meet contractors to perform necessary repairs. This can add up to a lot of money left on the table at tax time, and it's very important to have a system in place to make sure you catch them all. Now, for number two, selling an investment property. This is the biggest mistake I see people make. Every year, I have at least one person tell me they wish they knew this before they sold their property. So let's look at a typical scenario. You buy a property in year one for $300,000. After 5 years, you decide to sell the property because there's a nice gain, maybe you'd like to take some profits, or you're simply fed up with managing the property. This creates a taxable event, which means if you sold at a profit, you will have to pay capital gains tax. In our example, the tax due is $15,000. Now, there are two strategies to defer, potentially eliminate your taxes. Let me explain both for a second. Strategy one is a 1031 exchange. You simply roll the proceeds into literally any piece of real estate. Strategy two is called a qualified opportunity zone. This is relatively new and widely unknown since it was created under the Trump administration's 2017 Tax Cuts and Jobs Act. These are federally designated areas that you must purchase real estate located within the QOZ boundary. In order to utilize either strategy, you must follow specific timeline and criteria. One of the biggest rules is you must roll over the proceeds from your sale within 6 months via a 1031 exchange or a qualified opportunity zone. Now, there are other rules to follow, but we are trying to keep this example simple. Let's look at the outcomes. In a 1031 exchange, you will defer taxes until you eventually sell the next property. Or taxes can be eliminated when the property is transferred to your estate. With a qualified opportunity zone, after 5 years, you will only owe $13,500 in taxes. If you hold the investment for 7 years, your tax due will get reduced down to $12,750. And if you hold the investment for 10 plus years, the IRS will eliminate the amount of taxes you owed from that sale down to zero. That is a huge, huge advantage. Now, I have seen first responders sell a property, they pay the capital gains tax, and a year later, they're ready to go buy something else. Since 6 months has passed by, their opportunity to defer or eliminate the taxes is gone forever. When I ask people why they didn't consider these strategies, it's because they simply did not even know it was an option. So, if the professionals you are working with don't bring this up, or worse, do not even know about these strategies, that's a huge red flag. Now, for a quick summary. Proper planning can save you thousands of dollars in taxes. And if you'd like to learn more about tax deferral strategies, QOZ opportunities, or set up a tax strategy review, reach out by visiting my website, valoradvisors.com, or even email me directly, michael@valoradvisors.com. I hope you found this helpful and informative, and I look forward to hearing from you.